Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Welcome to Life Insurance and Defined Benefit Plans. Let's talk about defined benefit plans for a few minutes and about why you might want to have life insurance in there. First of all, you have someone who may be convinced that a defined benefit is a good idea for them. Usually it's a prospect, someone with 10 or fewer employees. They want significant tax deductions. Hopefully that plan can be designed so that the tax savings they get every year will exceed what they have to put in for the employees who are in that plan. They may want to save for retirement. They may be looking to accumulate more than $2 million over 10 years for that retirement. May be attracted by the protection from creditors that plan affords. All those reasons are good reasons to adopt a defined benefit plan, but maybe they want to consider life insurance in that plan. Statistics tell us that 3 out of 20 people will die before they reach age 65. Kind of depressing, certainly sad, but business owners are not immune. They may set up that plan right now, looking to save for retirement. We hope they get there, but we know that some of them will not. For those of them that do make it, statistically, also reality, those who make it to 65, we know 100% will die thereafter. So eventually that life insurance benefit will be paid. It's not a benefit that will be lost and not put to use. We hope it's later rather than sooner. But why put it in the defined benefit plan? Well, there are several reasons. Most significant among them is that it's less expensive. All the premiums will be paid with pre-tax dollars. There's no other way really to do that, to buy your insurance. It provides survivor benefits in the event that person doesn't make it to retirement. Suppose they're planning and hoping to have that $2 million when they get to age 62, or 65, whatever age they've chosen, but they don't make it. Perhaps they're leaving behind a spouse or someone else dependent on that money. By putting life insurance in the plan, it will self-complete that plan, making sure that money is there for whoever that needs it. The pure amount of risk under that life insurance policy, the pure death benefit, will pass income tax-free to the beneficiary. Cash value that builds up in the policy is taxable because that's funding the retirement benefit. That is part of the retirement benefit. But the pure insurance amount will pass income tax-free to that beneficiary. And the policy is permanent, whether it's universal or whole life. It's always permanent insurance that we're purchasing in a defined benefit plan, so they can always take it with them after they retire if they still have that need and they want to keep it. Now, while it's in the plan, let's take a look at slide 7. Here I have an example. Let's say you have someone, there's no insurance in the plan, and in the future they're going to have $1.3 million at their retirement. But suppose they died early. In this case, their accrued benefit, we're saying, was $712. $347. That's what their beneficiary would receive because they hadn't accumulated the $1.3 million yet. Now we put insurance in that plan, and now if they make it to retirement, they'll have that same $1.3 million because this is a defined benefit plan. We cannot take away from that benefit. It's promised under the plan document. Now let's say they died at the same time. They have $347 of accrued benefit, but they also had life insurance in the plan. Now, that insurance could be a variety of amounts. We've put it at the maximum here, which gives them another $5,387 of benefit that would be paid to that beneficiary. And we all know, had they not done that, the beneficiary would get the $712, and maybe that's not enough. Maybe the $5 million is an appropriate amount. Maybe that's too much. We could have set the insurance at $1 million or $2 million or $3 million or $4 million, whatever they think is appropriate that they want to leave behind for that beneficiary. Now, obviously the great thing about buying the life insurance here is that all the premiums will be tax deductible, so that makes it a much cheaper place to buy it. You get great efficiencies. Not only is it all deductible, but let me show you how the numbers work out. The way the calculations work in a defined benefit plan very much favor that participant. And That's because the cash value in that policy is helping to fund the retirement. That's cash in the plan. And so the only increased cost is a net realized cost for the actual life insurance protection. That's what drives up the expense of the plan. So let's take a look at a very simple example on slide 9. I have a 55-year-old without any insurance in the plan. They're doing a defined benefit plan with retirement at age 65. They're going to accumulate a little over $2.2 million. To fund that plan, they'll have to do a contribution according to the actuary of $137,358. Okay. Now we add life insurance to this plan. Now we're just putting $1 million of coverage here. We could put more, but let's just do $1 million. They get the same 2.2 at retirement. We can't take away from that, but it does move up the contribution to $138,000. Now, how could that be? It increased the plan contribution. You can see on slide 10, $642. Now that's all deductible as plan contribution, so knock about a third of that off for tax savings. So out of pocket, it's costing them, probably about $450. The premium for this policy is $28,600. So if they had to buy this insurance outside the plan, they'd have to gross the earnings, pay the tax, net the $28,600 to buy that same amount of coverage that here cost them out of pocket about $450. In fact, it's such a small increase to the plan cost, it's almost questionable why you wouldn't put the life insurance in there to make sure that that plan benefit is guaranteed. Now let's take a look at a case study I've got to see how this all plays out. I've got 2 owners, 2 employees. Let's see how it would look if we did a defined benefit plan for them, just a traditional defined benefit plan, and we did no insurance in the plan. The contribution is $270,255, with 90% going to our 2 owners. Now, the older owner has a larger contribution amount because they're older, and age is a factor here. Now, if we added life insurance to this plan, the plan contribution goes up to $288,299. They're getting 91% of that. You can see the increase up to $197,373 for the older owner, $63,697 for the younger one. And you can see the amounts of insurance, $2.88 million for the older owner, $2.5, almost $2.6 for the younger one. And the employees get insurance too, because in a defined benefit plan, you have to have equal benefits, rights, and features, so we have to have insurance on everybody. We have to not only have it on everybody, but it has to be on a non-discriminatory basis. That means we use the same products for all the participants, and they'll have the same relative amounts based upon the contribution funding their benefit. And so what we cannot do is put, for example, whole life on the owners and term on everybody else. That would not be equitable. So they'll all get the same policy. Now, participants always have the right to waive the insurance. There's usually not a reason for them to in a defined benefit plan, since it is all being paid by the employer, but they always have that right should they want to exercise it. And we always have to stay within the incidental rules. There are 2 ways to apply those rules in a defined benefit plan. The simplest way is we take the projected monthly benefit at retirement, multiply that times 100. That's how much insurance they can have. For example, if they were going to receive $1,000 a month, we multiply that by 100, they could have $100,000 worth of insurance. The way we usually use is the other way, though, which is Revenue Ruling 74307. This rule's been around since 1974, and it's a percentage test where the actuary does a calculation, applies of what the contribution to the plan would be without insurance, and then can take an amount that's equal to 2/3 of that for whole life or 1/3 for universal life, and that dictates what the premium amounts can be. You don't have to worry about those calculations. The actuary will do that. Now, but it can generate very substantial, very large amounts of insurance if that's what the employer wants to do. Now let's talk about when the death benefit's paid. If the death benefits are paid while the participant was still in the plan, the insurance company pays the plan trust. The plan trust then turns out and pays the beneficiary that that person has designated. They will get the full death benefit, but the cash in the policy is subject to income tax. The net amount at risk, the difference between the cash value and the face amount, will be paid income tax free. Any taxable amount, there's basis to be claimed against that, which is an amount that's been paid every year by that participant called the economic benefit. Whenever you have life insurance in a qualified plan, it's an immediate benefit, and there's a value to that, and that is reported out as taxable income to the participant. It's called the economic benefit, and that is recouped later on when the death benefit is paid or when the policy is distributed. Now, how much is that amount? It's based on Table 2001. It's only calculated on the net amount at risk. This is what used to be the PS58 amount. Now, you can see I have a table on slide 17. I show what the PS58 amount used to be, what the current Table 2001 amount is. I also have a column there called Alternate Reportable Term Cost. Insurance companies are allowed to use their own alternate term cost if they meet the requirements of the rule. Some companies do. Here's some example amounts of what it could be. Not quoting any particular company, but you'd have to check with whatever company you're using to find out if they do that and what it might be. But you can see, let's say for the 45-year-old, the old PS58 amount on $1 million was quite high. It was $6,300. The new table that's used, it's only $1,530 that's reported out. That's added to their income for taxation. In my example here, a possible alternate cost might be as low as $500. Check with your insurance company and see whether they do that. Whereas here, the premium was actually $17,000. So you can see from this chart, the reportable amount, whether using Table 2001 or some company's alternate term cost, is very low relative to what the premium is, and that will be a wash as is recouped later on as basis. Now, whenever you put insurance in a plan, you have to think about how it's going to come out later on. In a defined benefit plan, it will come out at retirement. Once someone is no longer an active participant, you cannot keep the insurance in the plan. At that time, they could surrender the contract if they don't want the insurance anymore, and the cash value would be has been helping to fund their benefit. They could roll that to an IRA ultimately. They could take distribution of the policy. The cash value will be taxable. They recoup that taxable term cost that they pay, that economic cost they paid as long. They could buy it out from the plan. They could purchase it out for its fair market value. That means they have to come up with cash to buy the policy out. They buy it out. Now they have a personal policy, retain the death benefit, has the cash value in it. They own the policy and they do whatever they want with it. The plan is whole because they have paid them an amount equivalent to the fair market value of that policy. And fair market value is determined under IRS rules. It may or may not be different than the cash surrender value of that policy. Lastly, some companies offer an exchange program where the policy is actually surrendered in the plan and the company issues to that insured participant a new policy outside the plan. That way there's no taxation. They didn't have to come with any cash to buy the policy out. The cash value that was in that policy stays in the plan and can ultimately be rolled to an IRA. But check with your company. Some companies offer those features, and it's different at every company that does it as to how the particulars of their policies work. So that kind of quickly sums up why you might want to put life insurance in a defined benefit plan. Very popular strategy back in the 80s. A lot of this was done in defined benefit plans. As plans were terminated, it kind of went out of favor for a while, but it is very much back and in the forefront and in the interest of people. Once you see how the economics work, you can understand why that would be. So consider it, think about it. If you want to get some more ideas or talk more about it, certainly feel free to call us. Give me a call. I'll be happy to talk to you about it. And then, of course, work with whatever insurance company it is you want to work with. So please call us. We're always here to help. Thank you. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.